In this lesson, I want to go over reasons 4 to 7 of why you should trade Forex. Number 4, no fixed lot size. You determine your own lot or position size. This means you can control risk. Again, comparing this benefit against most other markets, and the level of control and customization is simply not available or possible in other markets. Many exchanges set fixed contract sizes, which are utterly inflexible, which makes strict money management much more of a problem. Number 5, low barrier for entry. You can get started very easily with a very low amount of starting capital. It is very easy to set up and fund your account with a broker, and with mini and micro lots, you can get started with the low amount of money. Just about anyone can afford to open a new Forex account with as little as $250. While this may be a totally inadequate amount to expect to be able to earn a living from, it does at least provide a foot in the door of financial trading and allows individuals the experience, practice, and ability to learn the skills of trading at a tiny cost. Learning to trade Forex is considerably cheaper and less risky than learning to trade any other instrument. Number 6, high leverage. Leverage increases how much money you can command in the market. It effectively means someone will lend you money to help you punch above your weight. For instance, with $10,000 and 10-to-1 leverage, you would actually be able to trade one standard lot of $100,000. Increase that leverage to 100-to-1, and the same $10,000 would be able to control $1 million, or 10 standard lots. In other words, it makes your money go further. Without wanting to insult anyone's intelligence, the leverage amount lets you trade by the factor above the amount of money you really have. 10-to-1 allows you to trade 10 times more than you really have. 100-to-1 lets you trade 100 times more, and 400-to-1 allows you to trade 400 times the amount you really have. No other market in the world offers leverage at the same levels as Forex. Number 7, low margin requirements. Margin is simply the amount of capital your broker requires you to have in your account in order to trade a certain amount of money. If the margin requirements are low, it means you do not have to have very much money in your account in comparison to the actual amount they will let you trade. Low margin requirements means you can trade with an amount several times larger than your account balance. For example, 1-to-100 leverage means you control $100,000 of currency for only $1,000 in your account. Again, in comparison to many other markets, Forex is unrivaled in low margin requirements. While you may be asked to put up as much as 50% margin in other tradable instruments, with currencies you regularly only need 1%. Smart traders can make their money work a lot harder in the foreign exchange market as opposed to any other. But do keep in mind that increased profit potential can also mean increased risk.